Welcome guys. Within this video I would like to comment on the current market environment in general. As you know, major stock markets have taken out all-time highs during the last month. We are coming to the end of the 8-year bull market, but it's very important to remember that all this growth in the stock markets is rather driven by the central bank policies of very low interest rates. So it's more artificial growth than actual organic growth. That means that we are coming to a stage where major markets are more than overheated, and the likelihood that there will be a major correction in the next 20 months increases. So basically we are now in a stage where soon the big stock market indices, the S&P 500, the FTSE, the Eurostoxx, etc. will actually go through a phase of correction. And there could be quite severe consequences also for the real economy. I mean, it should also be remembered that fundamentally nothing really changed since the last financial crisis. And there are always different factors which trigger an actual crash or a correction. Like last time it was the mortgage-backed securities market. But there are many factors which could trigger such a correction. But it's important to understand that structurally we are in a pretty similar situation than before. So basically the financial economic system is the same. So we still have major banks who are doing all kinds of different banking business under one roof. We have no clear separation between the investment banks and prop trading. Even some investment banks also run their own hedge funds. So at the same time we have central banks like the ECB and the Federal Reserve and the Bank of England basically going through a phase of very low interest rates. So the system is pumped up with liquidity from that side, and stock valuations increased significantly in the last month. So however, when you do your historical analysis and you look at market phases from before, you will realize that the situation is now becoming more and more dangerous. So basically, be very careful. If you are long stocks, if you caught part of the bull market, don't be greedy. Take some profits off the table. Don't wait until the whole markets turn again. And if you are someone who heard a lot of stories in the last years of students trading out of the dorms, making money with stocks, etc., be aware that once the market turns and a lot of people lose money, you won't hear equivalent stories. There's a survivorship bias going on. So in financial markets you need to also play defensive, and you need to have the ability to also even leave some profits on the table. And now we are approaching the end of the year 2017. So don't be one of these people who actually just hold on, and once the market does a deep correction and, for example, a pullback, and then takes out the low, don't be some of the people who just try to hold it over, because then it could be equivalent period of a multi-year period where the market actually consolidates and decreases again. So this is quite common sense, to be honest. And even if the market, for example, takes out the high in the last month and maybe goes a bit more up for half a year, you have to be psychologically okay with that. If you got a nice part of the bull market, don't be greedy, protect your profits, otherwise they will be taken sooner than you can think. Now the other topic is, of course, because the market just went up and up and up, many hedge funds have underperformed who are in the space of equities, or who have some exposure to the stock markets. Many have, and many are in some way correlated to the overall market development. Um, so of course, investors may say, well, they underperformed, the markets went up a lot, I could have put my money all in the stock market instead, and so on. They realize that once the markets turn and things become more complicated, then in general there is this significant inherent risk in the market if you're just going for a long only strategy, because it's completely phase dependent. If you got a bull market, okay, then you say, oh, it's so easy to trade, but then when the markets change, things become more complicated. Of course, some people may say, okay, I caught a nice bull market, I sell my stocks, I cash in, and now there is a more complex phase coming, where maybe the market ranges, and then whipsaws a bit more, and then there can also be big corrections, stop runs to the downside, etc. So I switch to more active strategies. But let me warn you, so active trading, when you go long and short, when you trade in the short term, whether you do it systematically, etc., is a very, very complex endeavor. You should respect it. If you don't have any evidence backing up that your system or strategy actually works, don't go live. Yeah? So there are a lot of barriers when it comes to active short-term trading, and of course it is desirable because, for example, when you trade, let's say, the foreign exchange markets in all directions, long, short, over periods from a few hours to a few days or to a few weeks, etc., it basically doesn't really matter what the major stock market indices do. In fact, if there's a lot of volatility, that tends to be good because there are moves to be caught in the Forex markets as well. So that's a reason why people engage in short-term trading, in active trading, in foreign exchange markets, etc. But be aware that this is a complicated endeavor. You need to have an edge, as it should be clear by now, looking at all the other videos I posted. You need to actually know what's going on in the market. Otherwise, you will just be a sitting duck, and you will be part of the dumb money who gets stop hunted, who gets position hunted, etc. So keep that in mind. Yeah. Whenever you want to go systematic, and let's say you want to apply a statistical strategy to the markets, in the best case automate it if you go that route, be aware that you must have done your homework. Okay, you must prove to yourself that the strategy has any potential of a positive expected value over different market periods. Yeah, so we're talking about a training period, ranging period, whipsaw period, etc. And back in the days, these periods used to be maybe different, several years. Then it changed to maybe 6 months, and these days it's more like 3 months on average. Yeah, so every 3 months the foreign exchange market mode tends to change, which then leads many automated strategies to get into drawdown. Yeah. So you need to do proper testing, you need to have tick data, you need to have realistic testing, which also incorporates slippage, spread and commissions and all that, yeah? And the actual tick movement within the bar. And you need to do it over longer time periods, and you need to have evidence that your strategy actually works over different market modes. In the best case, you also do forward testing on a demo account, you let it run live, etc. And then when you have this evidence, and you also start to do live trading on a small level, then you can try to go for a systematic approach. Yeah. But before you did not tick all these boxes, there's no point going live, because you could even be under the illusion that your strategy is profitable, and actually it's not. Yeah. Even sometimes strategies look profitable visually, and you see very good signals when you do visual backtesting, but once you run the actual backtest with all the trade executions, things don't look so rosy anymore. So to summarize, be careful. Yeah, the bull market could come to an end soon. Some people say there could even be major corrections in the economy and in the society. This is definitely possible. Don't be greedy, protect your profits if you caught some. Don't assume that just because we went through a bull market phase, things will stay the same for another 7-8 years. That will certainly not be the case. If you try to get into non-directional trading into short-term trading, into swing trading or scalping or day trading, and you want to do it in all directions, long, short, etc. Be aware that this area, while it's highly attractive, it's very, very complicated, complex. You need to actually do the homework. You need to manage those barriers I explained beforehand, and then you may have some chance of actually being successful. If that didn't happen, then there's no point for you to risk your hard-earned capital in the markets without having done that homework. Okay, trading is the opposite of gambling. So in trading, you want to exploit an edge you have, whether it's a statistical edge or otherwise, and you want to have the odds in your favor over a high set of trades. Okay, so I hope you enjoyed the video. I hope you do the right thing, and I wish you all the best.